Now we're only paying 60 cents for that calendar spread. If it were to rise to 145, we would achieve our maximum profit by expiration. The most we could lose is 60 cents. With a calendar spread, the most you could lose on any of these spreads is the price that you pay for the calendar. And you can see that our margin requirement is only $60. And if we extend our graph out, you can see also that the maximum loss is $60 no matter how high the price went and no matter how low the price went. That is a bullish calendar spread. In other words, you're determining that the price is going to rise until expiration, and then you would achieve your maximum profit at the price that you purchased this calendar spread. Let's go back to our trade tab for a second. The nice thing about calendar spreads is that you can buy them just like you can with an iron condor. You can buy them on the put and the call side. So let's say you're modestly bullish, but you're also modestly bearish. You think that the prices are going to fluctuate within a certain range. Well, you could buy a calendar spread. Let's say you think the price might rise up to $1.40, but you also think it might drop at the lowest point to maybe $1.34. We don't want to sell one of those. We want to buy it. There we go. Now let's take a look at what that does to our profit picture. And I just need to take off that one that we did before. There we go. What does that do? Well, it's very interesting, isn't it? Instead of the single tent, like we had before, like this one, if the price were to rise up, we would achieve our maximum profit at 104 on a bullish calendar spread. Now we also have a put calendar spread. And now we have two places at which the final price of the underlying stock could settle on expiration day, and we would achieve our maximum profit. In this case, it's 140 because we have a 140 calendar spread, and on the downside, 134 because we have a 134 calendar spread. All we did was take one calendar spread and add another one to it. Now, not only do we have a much wider profit margin, a potential for profit in this position, but we also have a little bit wider break-evens. We have 142 all the way down to 142 down to 132. If we were only to do the bullish calendar spread, then our break-even points would be at 136 and 144. But by adding the bearish calendar spread, we've extended our break-even all the way down to 132. So that's what, in fact, that's exactly what we've done here, is created a double calendar. That's exactly what a double calendar is. It's two calendar spreads, a call calendar spread, which is slightly bullish, and a put calendar spread that is slightly bearish. If we were to take off the call calendar spread, you can see that the maximum profit would be achieved on this calendar spread if the price of the underlying would move down, and it would be in our potential profit area of our calendar spread. When we put both of them together, we have a slightly wider range in which our prices can move to achieve a profit. We also have a greater theta. When we add these positions together, you can see that one side has a 38-cent theta. If we add both of them together, we have an 83-cent theta. And of course, that theta will increase in time as we get closer to expiration. So now you've been introduced to vertical spreads, the sale of vertical spreads, combining the sale of vertical spreads into an iron condor, calendar spreads, both at the money and a bullish calendar spread and a bearish calendar spread, and then the combination of the two types of calendar spreads, both on the call side and the put side, to create a double calendar. Anyway, guys, I hope this was helpful to you to understand the type of positions and how we profit from them. And I really do hope that it helps clarify, at least for some of you guys, the very foundation of what we're trying to achieve, which is positive theta positions, the spreading of a wide range of break-even points, combining vertical spreads or combining calendar spreads in order to achieve our objectives. And this is just one, we did about 2 hours today. Please review this video as many times as you feel necessary in order to really understand the very basics of what we're doing here. This is the foundation of building positions, is understanding the type of positions that we put on. We covered the iron condor, we covered the double calendar, we did calendars, and we did vertical spreads. So this is really a very important foundation for you guys to understand exactly how these positions profit and also how to put them on, understand why we do both the sale of options and the purchase of options to protect ourselves. So if you have any questions at all about this video or anything that I went over today, please do not hesitate to ask me questions at tradingology@gmail.com. Hey, I wish you guys all the best, and go out there and trade with confidence.